Hi guys, it's Chima here. In the last video, I talked about institutional trading, institutional forex, why 90% of traders lose money. Today, I have a screen here. It's been a long time since I did that video. It's been about more than a week, and that's because I haven't been able to do the follow-up because I've been jumping from one desk to another, one trading desk to another, and it's been a whole lot for me. It's not been really easy, but I'm here to do a second video, and I really want to take it slow. Actually, you can see if you didn't watch the first video, please go back and watch that video so you can understand a little bit of what I'm going to talk about here. So I'm going to talk about what I will elaborate on in the next video, which will come shortly. It's not going to take so long like this one did. So on my chart, you can actually see movements to the downside, which indicates the movement of price to the downside. So I just want to talk about how the manipulation occurs in the market, how this manipulation basically occurs, because this is the most basic way you can find manipulations in the market. So I'm just going to go talk about that briefly and talk about how to find these manipulations and how to trade up the manipulations. Now, if you watched the first video, you would have heard me say several times that the banks or the big trading desks are involved in manipulations, and they are interested in getting money out of the market on a daily basis. So how do they do this? So if you watch that video, you may be thinking, well, they're out to reap me, but the thing is, they have an enormous supply of money, and sometimes it can be really hard to take trades. They can't trade like retail traders do. So they can't just come here and buy and come here and just sell like that. Okay, in order for them to buy, they have to sell. In order for them to sell, they have to buy. So it's really how it works for the banks right there. So the question would be, how do they do this manipulation? How do they carry out their day-to-day trading activity? Activities in the market. You may have heard that for every buyer there's a seller, and for every seller there is a buyer. So it's just how it is, demand and supply. You've heard about that kind of thing. So let's say the banks are going to buy here. Okay, they're going to buy $50 million here. Okay, they're going to need someone who's going to sell $50 million to them. Okay, and you have to know that the market is filled with a lot of things go on in the market. So the banks that do spot forex trading, where they have to buy large volumes or they have to put in large orders in the market, they find it really difficult to place those orders, to get these orders filled. So let me go back down now. If you look at the screen, you'll see the movement all the way down. It's a downtrend, and you can see what I call the accumulation right here. So if we are here and we are about to buy, basically I'm going to go back to the charts after looking at this. I'm going to show you practical examples of what I'm talking about right here and right now. So if we are looking at the accumulation right here, what is meant by accumulation? It means that there are many orders going in the market at a particular point in time, and it keeps the market the market doesn't really move in a particular direction. It doesn't move upwards or downward. It just goes, it consolidates. Okay, to put it that way, it consolidates. So if you have all of these orders in the market becomes more like flat. Now, let's say the banks are looking to take a trade, because if you are buying, you need your broker to pair you up with someone who's selling. Okay, and if you are selling, you need your broker to pair you up with someone who is going to buy. So that's how it works. And the banks also need the other side of their trade to be filled. Okay, so if they're going to buy, they need someone who will sell to them. And if they're going to sell, they need buyers. Okay. So, but the good thing about this for them is the fact that they can create these things. So that's how the manipulation comes in. That's how the manipulation of the market happens. So if the banks are looking to, if the banks are looking to buy here, okay, actually they're looking to buy the overall movement of the market. You may have done your analysis and you said the market is going up. Yes, of course it's going up, but before it goes up, that's because the banks are going to be buying. But before buying, a lot of other traders are actually doing the same thing. Every other trader is buying. Everybody is going ahead to buy. So the question is, who fills the order for the banks? Now, listen, the banks have very large orders because they don't trade like we retail traders. The big trading desks don't trade one standard lot or five standard lots. They trade in the millions of dollars. So if you're going to put in a buy order for the euro dollar, let's say this is the euro dollar, and they're going to put in 15 million or $100 million. Okay, they're going to be buying $100 million of the euro dollar. I'm going to change this now to larger. Okay, and if they're going to buy 100 million of the euro dollar, they're going to need someone, or they're going to need the other side of that trade. They're going to need they're going to have to create sellers. Okay, let me put it this way: if they're going to buy $100 million, $100 million worth of the euro dollar, it means that they're going to need a supply of $100 million. Okay, but if the bulk of traders are actually buying, that order will find it difficult to be filled and to be placed in the market. Okay, it will be very difficult for them to put in that order and have it executed for $100 million. So what they are going to do will be, because they need people who would sell, okay, to them, because they need part of that order filled, maybe 15 million. They need 50 million filled from retail traders. So what they're going to do, remember they're buying $100 million. So if all the traders at this point in the market are actually going ahead to buy, it means that that order cannot be filled real quick because it's really, really large, very large. So in order for them to have at least half of that $100 million filled, what they're going to do is they're going to actually go ahead. One tactic, actually, this is one of the ways they can actually create liquidity, or they can actually move the market or manipulate the market. So what this means is that a whole lot of traders are having orders at these very popular area in the market. You want to call it a support level. A lot of traders are buying. It's very obvious. That's why I did it this way. It's very obvious. And if you were trading the market, you would be looking to buy at these levels. You'd be looking to buy at these levels because the market had tested first time, second time, and this is the third time. You would have bought and you would have made some profit. Very okay. You would have made some profit. But the banks going down, the banks now need to fill part of their order because it's very, very large. So if they're going to buy, they need people who are going to be selling. So those sell orders are going to fill part of their $100 million order because it's very large. So what they're going to do, they're willing to put in some money in the market. They're willing to put in some money because if they don't do that, they're not going to have these trade filled, or they're not going to have their trade executed. Okay, they're not going to have that supply that they need. So this is where the manipulation comes in. So if you are here and you just, as a retail trader who's got who has the information that everybody has, and you are looking to buy at this level, and you do so, and quite all right, price moves up a little bit, you can actually see that I have a little bit of a push to the upside before the market plummets a little bit below these support level. So what this means is that if you had bought at this level, you'd have had your stops here. okay, you would have had your stops here. So the stops at this level, you said, I said candle grabbing, liquidity clearing, long orders, okay? So a lot of long orders are lying here. And some other traders are going to be putting maybe some sell orders, some pending orders just below these support levels. So in case the price goes down and continues to go down, it will trigger on all those sell stops, okay? All those pending orders and continue all the way down. But the market doesn't do that. Instead, what the banks are willing to do in order to get this $100 million filled is to put in a little bit of money, maybe 20 million, okay? I don't know, 20 million. Let's just say that they're willing to put in 20 million or more. If this is a more like 200 million, they would, let's say they're going to be willing to put in 15 million. But for the purpose of what we already started with, $100 million, this is theory right now, so I'm going to use 20 million. So $20 million, they are going to, while a lot of the traders are buying and they've got all the liquidity here, what I mean is that they've got all the stops and all the pending orders and everything. A lot of orders are just below these levels. So the banks can see that, and what they need to do to have this $100 million filled is to take out and clear out all these orders, okay? They need to clear all these orders. Now, what happens is when price begins to go up, the banks are selling into one of these candles right here, and boom, price drops all the way down. It clears out of these, all of these pending orders right here, the stops that are here, and the pending orders that are just below that. They clear all of that. They take all of these out of the market. So after clearing all of these, it means that a lot of traders now have, let's say they've got sell orders here instead of buy orders. Okay, now they've triggered all of these sell orders. What are they looking for? They're looking for sells because they want to buy. They're looking to buy 100 million. So let's say by putting in $20 million in the market, with the aim of getting $50 million buy field, they are able to get a little bit, they're able to get half of that because now a lot of sell pending orders are now triggered. Okay, while the bulk of the liquidity right here, all the money here isn't taken by them, at the same time triggering the sell orders of retail traders, the sell orders, the pending orders. So they've got a little bit half of this $100 million field, okay? And now they can begin to buy. It now gives them the ability to buy because they are now sellers who are willing to take the opposite side of their trade. So they can have $100 million field and boom, they go back up. Remember, okay, I'm going to take this out. I'm going to go back to, I'm going to try to take this out. All of these, shit. So now remember they took out all of the liquidity right here, triggered some of these sells and triggered a whole lot of sells for retail traders, enabling them to buy because if they don't have that opposite side, they can't buy and they can't have $100 million filled. So maybe they needed $50 million from here, and they've been able to get that. They've been able to see that the bulk of pending orders, sell pending orders, were lying below here, as well as liquidity. So they've cleared all those orders, triggered the sell pending orders, and after doing that, they're able to now buy because they have the other side of their trade met. So they can now buy the market. They can now buy $100 million. They've gotten the other side that they wanted because if they didn't do that, they wouldn't have been able to buy such large volume. Okay. So this is actually presented by, well, we can actually identify these type of moves by long candles and wicks. So you can actually see when a wick goes and breaks a very strong support level, what you call support, or clears in maybe a very sensitive price level, okay? Because this is a very sensitive price level, and a wick just goes in, clears that out, rejects and goes back up, all right? Now, the movements are always like this. So remember, they had to sell, they had to take what we're going to call an underground position, an underground position. They did that here. Okay. They took, while prices going up, retail traders thought, okay, the price is going up now, and boom, all right, they sold, okay, triggered all that stuff, cleared a lot of people, took everybody out, and so they were able to have that 50 million, the other part of the 50 million field, so they could buy 100 million. So now, before doing that, remember that they had to sell. Their original position long term is a buy, but they had to sell. They had to sell it to 20 million. So while price went up, went down, they were able to clear that and trigger. I talked about that earlier. Now price goes up, they're able to now take their original position, okay? And price goes up. Now this level here, remember they took a sell. So it means that if price goes up, they're going to be in a drawdown, or they're going to be in a negative position. So this is an underwater position that is necessary to get liquidity and to complete a very large volume of order by the large banks and the trading desks, okay? So this is an underground position required to get the original planned move to the opposite side, okay? So they do this, and now when price goes up, they're going to be in a drawdown here, and price comes back down. They're able to mitigate on that position. They're able to mitigate on that underwater position, or they can come back very later in the future to do that. So these manipulations are very necessary by the banks and the big firms. They don't do it all the time, but when they have to buy very large volumes, they have to do this, okay? It happens all the time. You can see it all. Okay, I just said it doesn't happen all the time, but it happens most times, all right? It happens most times. There are times when you can't, it may not be very visible, and there are times when it is very visible. And they happen at areas where we call liquidity pools, okay? Areas like this would be a liquidity pool. I'm going to explain, I just have to put in a text here explaining that this is a liquidity pool. So let me put that down, liquidity pool. So areas like this would be considered liquidity pool. Why is that considered a liquidity pool? Because we've got a lot of traders who are taking a particular type of position on that level. Okay, you've got a whole lot of pending orders lying below that level, so it's a lot of money, and it can be used to move the market. At the same time, all these pending orders can be used to trigger the other side of their trade, so they can take these big trades. If not, they're not going to be able to enter these trades. Okay, if they don't do this, it means that they're going to have to wait for a longer time, and when they actually now have the ability to take these big trades, it's going to enter at a whole different price. Okay, we're just going to have something called slippage, so they're not going to be able to take that big order. So it happens here, it can happen here. It's just the same thing. Price goes up, a lot of retail traders on the downside, a lot of retail traders are beginning to sell because it looks like, wow, the market tested, it's happening again. And a lot of pending orders are going to be lying here, just above here. And the stop loss is just going to be lying at the top of that candle. So at the top of that heads and shoulder, or whatever it is you call it, or you want to call it. So a lot of pending orders are just going to be lying just here, and what they want to do is come back here and take those pending orders, okay? Because they needed to trigger their own trades. So they get all of that, so it gives them that supply that they need, to push the price down or to sell these big orders, and then boom, and it's just collateral damage that retail traders are the ones that are affected by this. So the retail traders get taken out. A lot of the orders at the top of these area, all these orders are cleared out. So one candle may be mostly a wick, okay? Wicks in everybody, wicks out everybody rather, candle grabbing liquidity, clearing short orders. At the same time, it also opens and triggers the long orders because they need these long orders to as supply for their short orders, okay? If not, they're not going to be able to maybe sell that large order, maybe 100 million or 200 million. So they need a part of these to fill their big orders, and that happens, and they're able to take the price down. So that's one part of it. So in the next video, I'm going to go into how to see this. How can you see this? But before the next video, I'm just going to go look at the charts and show you how this happens. Right here we have the euro dollar on the 200 on the 40 on the 4-hour chart. So I'm gonna zoom in. I'm gonna try to zoom in. Okay, I'm gonna go to the 1-hour chart so I can break this down. You can actually see some markings on my screen. It is okay. It ain't loading. I'm waiting. I am waiting. Okay, I'm going to take you here now. So, okay, sorry about that, guys. Why isn't this? Okay. Anytime now. I guess I'm just going to go back to my normal MetaTrader 4. This one isn't coming up. So I'm going to just go back here and try to look for one that fits very well. Okay, I already have a marked chart here because I was doing some markings, and this explains what I've been talking about. This particular chart right here, you can actually see the moves. The market established a high right here. So a lot of traders would have been looking to sell at this level, okay? At this level, because the market had respected it before, and so you'd be looking to sell somewhere here. You'd be looking to take a short position around this area, and a lot of the stops would have been here, and you'd wonder if price goes up and continues to go up all the way up here, it should trigger some pending order. You'll be surprised the number of people who have pending orders at the top after these stops. So 1 week goes in and takes everything out. 1 week goes in. This has gone out. That's the problem with these. So we've got 1 week that goes out, takes everybody out. It takes everybody out. And look, I'm going to mark it. I'm going to try marking it now. I'm so sorry about this. That's the problem with the MetaTrader 4. Once you're online, you can't go back and look at certain things. So this candle right here takes all that liquidity. It is required. So when you see this, you know that they needed that in order to trigger some kind of pending orders that was out there, and they needed it to push the price down. And before going down, if you okay, this is the 4-hour chart. So in order for us to see that exact candle that took out that liquidity, we have to go to the 1-hour chart, okay? Because it was a really fast move. So we have to zoom out and go to the 1 hour chart. Now you see this candle right here. You see the first candle, and then boom. And then boom, we had this candle taking off after that. Oh, this is really frustrating. This candle taking everybody out, and then price managed to drop. So I'm going to go back to the 4 hour chart because this is giving me a little bit of problem. Price dropped and boom, it went back up to clear that, take that money that was used to push the price up, and boom, it continued all the way down. So this is one very good example. I'm going to show you some more examples. They're going to appear at places where you don't expect sometimes. And in the next video, okay, we have another one here. This here, right here, is what you're going to call a support level. The market reacted, went all the way up, came back down, but we had one candle. We had one candle right here that was responsible for taking out the price. I'm going to try to zoom this now so to avoid all of this that's going on now. Okay, now I can see it well. I don't have to go back and forth all the time. So we had this candle right here to clearing out all of that. You know, we had pending orders below that, or we had stop losses below this level, and boom, it cleared all of that. And so that was needed to put back in the market. And then after that, we had a very long candle, bullish engulfing bar, and they had to come back because they had to take an underwater position in order to push the price down. It's very required. It broke or breached some support. So, and now they had to go back to go all the way up. So in the next video, I'm going to go into details because some of the lines and some of the things that you see here cannot be explained in such a short time. So I will come back and talk about this in big detail, and I'm going to be looking at the chart. I'm going to separate the chart Monday, Tuesday, Wednesday, Thursday, Friday, and show you how to do this on the short term, how to see these moves and the tricks that are being used on the short term, and how to navigate your way profitably. So I'm going to see you there, guys. I hope this helped, and see you soon.